My name is Dennis Campbell. I'm a principal owner of Crystal Creek Enterprises here in DeWitt. And my grandfather was one of the first customers of Twin State Liqui-Grow here in DeWitt in the late 60s. So we are actually third generation customers of Liqui-Grow.
Hi, I'm Joe Derricks, and I've been with Liqui-Grow on and off probably for 30 plus years.
I'm Kent Bennis. I've worked with Liqui-Grow for 23 years. I'm a second generation Liqui-Grow user. My father worked with Liqui-Grow before I did for a number of years, so we've enjoyed working with Liqui-Grow for many years.
So Liqui-Grow helps my farming operation move forward in the fact that they have good technical advisors in Dr. Jake and Dave Audi and Abe. Really, it's the people. Flat out, it's the people that move my business forward because they are the expertise that I need to be a better farmer.
Very flexible in their schedule and with their outstanding people and equipment. So convenience, flexibility, and the service that they bring to our operation is critical in what we do as we try to grow corn and soybeans here. We can make one phone call and next year's fertilizer plans are taken care of. So to us, that's really important as we're trying to finish up harvest and work through a lot of the other activities in the fall. We know that when we make that call to Liqui-Grow, it's covered and that's off of our plate.
The communication between all their employees, with their salespeople, with their agronomy staff and the applicators, they understand my operation and tailor programs and agronomics that I feel are hard to find other places.
If I have a problem, boom, they're there immediately. They got somebody coming over, they got a pump coming over, they got products. If I have a question, they have knowledge to answer the questions. It's a whole total package.
The loadout facilities that they have here in DeWitt are outstanding, and they allow us to take our trucks and pull full semi-loads out and get those out to our planters and get back here in a timely fashion. So for us, that's really important to keep those planters moving in the springtime, and it's great to have that confidence that we know that we will be able to do that on a daily basis.
What I look for in a business partnership is someone that wants to have mutual benefit to both parties when we're doing business. Not every time does somebody win out. So there is winners and losers in these types of situations, and can't always be one-sided. And I feel like Liqui-Grow always tries to, look at that from both sides of the table. And I've always felt that, they always will work with me, whether it's to their benefit or my benefit. We've always had a great business partnership, year in and year out, when it came to good times and bad times throughout the different years.
High service level, a commitment to have the people and the equipment out there in the same relative working time frame that we are. They work weekends. Liqui-Grow is wonderful for being open early in the mornings and late in the evenings when the business of agriculture happens in those busy seasons. And that means a lot to us.
I look for partnerships that will help me move my family farm forward, basically. So I want to leave my ground in better condition than when I started. I want to leave my farm to hopefully a son or a daughter that wants to farm with me, and I need to have a successful foundation for them, and Liqui-Grow helps me achieve that through the expertise they have in agronomy and in their competitive prices, and really it's the whole ball of wax there.
We are loyal to Liqui-Grow for several different reasons, but first and foremost, we think it's really about the professionalism and the trust that the employees here have, and we have the confidence in their ability to make things happen when we need it done. So weather can get really crazy in the fall. We're still trying to finish up harvest. We may be still working on some seed corn acres, and we're still starting to start the tillage operations and cover crops. So we know that when we can call Liqui-Grow and have a quality job done very quickly, if the weather's changing on us, we think that that's really important to our operation. So it's about the professionalism, and it's about the trust that we have in the people and the equipment that they have here. We're also pleased with the relationship with Liqui-Grow because it's been such a long-standing relationship for us that we've got the confidence in their financial strength and their ability to recommend products to us based on what we need.
I know who the owners are. I feel like they've got their employees, their customers' best interest in mind when it comes to doing business. And I feel really comfortable that if I place money with these guys, not going to be issues down the road, making sure that that product gets to my farm, in a very efficient, and professional manner.
The convenience of having a Liqui-Grow, within a half an hour's drive of any farm that I have. Why, if I need something, if I run short, if I have a question, boom, I can either get an answer right away or somebody's out there helping me fix something. So it's a combination of everything.
Good morning, everyone.
Good morning. Welcome to the Lead Academy sessions. We're happy to see you this morning and glad that you can join us for this exciting panel discussion on the state of the U.S. economy. We are going to have another session on Thursday, so we hope you can join us then. It'll be our last session at 9 a.m. on Thursday, February 25th. That will focus on the ag market, and again will be another live panel discussion with experts. You can find the full schedule on our website. It will also be posted at the end of this presentation. In addition, we are offering CCA credits for these presentations, and you will find a link in the description, and there will also be a QR code posted at the end so you can scan it with your phone. We hope you enjoyed this exciting talk this morning. At the end, we are going to have live Q&A with our panel. At any point in time throughout the presentation or the live panel discussion, you can ask questions by posting them in the YouTube chat, or you can email us at questions@liqui-grow.com. Enjoy the show, and we will see you soon for live Q&A.
Good morning, everyone. My name is Kurt Struber with Advanced Trading in Bloomington, Illinois. It's my pleasure to join you today to talk about the state of the U.S. and ag economy and market outlook. The reason I'm with the group this morning is Advanced Trading is a commodity risk management company headquartered in Bloomington, Illinois, and we do business with the Rock River Lumber and Grain Group headquartered in Prophetstown, Illinois. And Rock River Lumber and Grain is a division of Twin States Enterprises, and Twin States is a parent company to the Liqui-Grow Group. So I was asked to be a part of the Lead Academy and look forward to that. And I'll be on the panel discussion after this presentation is done. I'll make a quick note that we're recording this almost a month ahead of the discussion time. And obviously in the grain business, especially in the current environment, things are changing pretty quickly. So there will be some dynamics that I'll list today that will end up being dated numbers by the time we have the actual session, but we can talk through some of those changes during the Q&A session afterwards. So again, pleasure to be here. Look forward to sharing some thoughts. To highlight a few things that we're going to talk about today, we're going to talk about corn exports and the share of total world trade that the U.S. has moved into here in the 2020-2021 marketing year that we're in. We're going to talk about soybean stocks, which are currently projected at a record low level from a stocks to use perspective. And with a tight corn situation and a tight soybean situation, we're going to talk about the acreage mix that the marketplace needs to see coming into the 2021 growing season. We're going to talk about trade with China, which of course has been a major driving factor in the grain markets here over the last several months. We're going to talk a little bit about money supply and the overall economy, not just specific to ag. And then we'll talk about some of the world situations, and we'll talk a little bit about some of the political volatility that we may or may not see through the rest of the marketing year. So wanted to start with a little bit of a lighthearted cartoon here, just the man on TV asking, what can we do to stop living in fear? And the easiest answer is, let's turn off the fear mongering. So my job today isn't at all to create any fear or worry. It's just to lay out some real parameters, some things that we think are going to be important to the grain markets and to the economy as a whole. So let's start by talking about money supply. This is a very, very basic graph, and it's the dollars in our M1 money supply. And if you think back to your college economics classes, the M1 money supply is readily available money. So it's cash, obviously, but it's also checking deposits, things like that. What it's not is investment accounts or even savings accounts, which are considered not as readily available. The point of the chart is to show that our M1 supply has climbed really sharply. We started to print some money in the early part of this millennium as a country, started to do that through a process called quantitative easing, and that caught a lot of attention, again, about that 2010 timeframe. But with the COVID situation and the economic collapse that we had last spring, March of 2020, we put a lot more money into the economy. And the stat that jumped out to us is 41% of every dollar ever printed was pushed into the economy since March. That's a lot of money supply. And the classic definition of inflation is too many dollars chasing too few goods. From a actual result standpoint, whether we've seen true price inflation, i.e. actual prices going higher or not, is a little bit remains to be seen yet from a consumer goods perspective. Obviously in grains, we've got some very high prices, but that's driven by other dynamics at the moment anyway, besides the money supply. So let's frame out a little bit what prices have done in the grain business. This is a very basic chart, as basic as it gets. This is the nearby corn futures price going back to 2009. And you can see the line across the middle there. Our recent high price as of this date, January 28th, our recent high price reached a level that we hadn't seen since 2013. We were a little higher than that coming off the 2012 drought, and we haven't seen a testing of those levels as of yet, but we've got corn prices at essentially an 8-year high today. On a soybean perspective, it's not quite as long a distance since we had the high prices, but nearby soybean futures are trading essentially the highest price since 2014. Again, kind of a tail coming off that 2012 drought that led to some higher prices, but we're in territory that we haven't seen in a long, long time. No secrets there, but just to frame it out, that's how high we are from a recent historic perspective. So trading in some territory that we haven't seen in quite a while. Let's talk about why that is. What really accelerated the markets, and we had seen prices jumping. We'd especially seen that on the soybean side coming through the fall and early winter in the calendar year 2020. But what really jumped us up from a corn perspective and soybeans to some extent was the USDA report released on January 12th. And the January report that the USDA releases is the only time in the whole calendar year that we get both the monthly supply and demand report and the quarterly stocks report coming out at the same time on the same day. So the January report day has a long history of often creating limit moves, and those can be limit higher, they can be limit lower, but there's a whole lot of information that comes out on one day at one time, and that tends to make the market move pretty aggressively. And it didn't let us down this year. We had corn end up trading limit higher on that day. And a couple of reasons why. Again, it's a supply and a demand report, and the supply side is what really drove the corn scenario. Two things jumped out to us. First of all, in January, the USDA traditionally releases its final yield report for the previous growing season. So January 2021, we got our final USDA yield figure for the 2020 corn production. And the USDA dropped that sharply. The graph you're looking at here shows changes in the January report versus the previous December report, so just a month prior. And any bar that goes to the upside shows a yield increase from the December report to the January. Any bar that goes to the downside shows a decrease from December to January. And when you look at the graph, which is about a 30-year graph here of history, it's the largest decline in yield in that 1 month period that we've seen in this time frame anyway. The USDA took off about 3.7 bushels per acre versus what its previous cropping estimate had been. So that's a big drop in terms of total production into the supply and demand balance sheet. In addition to that, the USDA went back and made a revision on the September 1 stocks report. So we get down into the weeds a little bit here, but back in September, The USDA made a previous revision on the June 1 stocks. So they went back, made an adjustment. That's the blue bar second to the right on this graph, showed a reduction in June 1 stocks at that time. And then in January, for the December 1 stocks report, the USDA made a revision to the SEP1 stocks. So we've got the USDA looking back on stocks and making revisions. And the most important thing in a stocks report is to have accurate numbers. So I salute the USDA in some senses in terms of trying to get it right. On the other hand, I've always used the analogy that a stocks report is a little bit like the bank statement. And when you go to reconcile your checkbook, to your bank statement, the bank statement is the Holy Grail, and everything else needs to reconcile to that. In terms of supply and demand reports, they reconcile to the stocks reports, if you will. The stocks are a surveyed figure. They're considered to be the Holy Grail. And if the stocks figure suggests a tighter stock scenario than anyone had projected, then something has to change in the supply and demand numbers to equal out to that stocks figure. And so when we get historic revisions like the USDA did in January, it makes analysts start to look at their balance sheet and say, where were we off here? Did we underestimate demand? Did we overestimate demand? And so seeing the big reduction in supply on the stocks report made us go back and say, all right, we must have underestimated demand to some extent or overestimated supply. So we've seen the market react really sharply to that, and we're still in the midst of a lot of volatility. And I'll be curious here, a month from now when we have our panel discussion to see what we've done from a pricing perspective, whether we've settled back down in the marketplace or if we've really gone to the moon. Either one of those looks, somewhat feasible at the moment. So let's pull back just a little bit and let's talk about the ag economy as a whole. And one of the best barometers for that to me is always land pricing. I'm from a farm background. My family still operates a farm in southwestern McLean County, and I'm fortunate to be a very small part of that. So I'm attuned to what's happening in the land market, probably not as much as some of you would be. But a couple of figures I wanted to share here related to land values. David Klein is a real estate broker here in Bloomington, an ag real estate broker, and happened to be a college friend of mine, and I follow him on social media. And here's a post that he had later in the week of the January crop report. So I'm thinking the seller of this piece of land was doing, dancing the day of the crop report and the price rally that came out because of that. Because 2 days later, the seller had an auction and sold some land here in southern McLean County for $13,600 per acre. That translated into a price of just about $100 per PI point. So the Illinois producers will know what PI points are. They're an indication of how good ground is, how productive it is. And the most productive ground, the highest PI that one can have is 147 points. So that's sort of the Illinois valuation, compares with Iowa's CSR2 values in that regard. So big number trading here in southern McLean County shortly after the January report. Looking at Iowa, this is a little more of a longer term look, but dollars per tillable CSR2 point increased statewide from $111 to $116, or 4.5%. And regionally in the state, at least according to this data, every crop district had an increase in dollars per tillable CSR2 point, except the district that was the epicenter of the 2020 drought. So a little tougher micro ag economy right in that area. Point being, ag land values have started to look strong again. It's not a projection looking ahead. It just says there's money available. There's a better return today at higher price levels than there was a month ago. And correspondingly, we've seen an increase in tradable values. So last land value slide that I wanted to put up here, this just talks about ag land values versus other investments, or specifically versus low risk government bond type investments. And the way this chart works, the dotted line uses the axis on the right side, which is the percent return annualized on a 10-year treasury yield. And if you watch any kind of financial press, you've known that for the last 10 years, really, we've had a pretty low interest rate policy here in the US. And then as of late, with the COVID-related economy, we've seen those yields fall even further. We haven't seen the 10-year go negative like some foreign countries have seen, but we've seen the values go relatively low. So we're not getting much of a return on no risk money, if you will, loaning money to the government via bonds. And the lines then are state by state average values per acre. So across all types of farmland classes. But you can see that, the big inflation that we had in that 2007 through 2013 or 14 timeframe kind of saw a leveling off since then. And we've started to see a little bit of a ramping back up. So the question raised there on the slide is, are land values still the best investment? They've sure proven over time to be a good stable investment and a good solid return and inflation hedge in that sense. So to the extent that we keep interest rates relatively low, we tend to keep farmland prices relatively high. And we'll see where that trends, over the next several years. Let's get back into the supply and demand things a little bit here. We talked about the reduction in corn stocks, September 1 and December 1. Talked about the reduction in yield levels that we saw. So let's look at what the USDA has thought we would have for an ending stocks figure. So to get into the details a little bit here, the red bars are what we're going to focus on this chart. And the red bars are the USDA's projection of corn ending stocks, or corn carryout, if you prefer that term. It's the same thing. It's a projection of the corn ending stocks on August 31, 2021. So the end of the marketing year that we're currently in, the corn that we grew in 2020, that we're using now through the winter and eventually spring and eventually summer of 2021. These are the projected ending stocks of that supply. So for example, in May, the bar on the left, the USDA had projected about 3.3 billion bushels of ending stocks, again, August 1, 2021. That's a lot of corn. And that's when we had prices relatively low. We were worried about what are we going to do with all of this. We had the COVID economy starting to hit. We were worried about ethanol production ramping way down because we weren't going to be using any gasoline. We were worried about our export figures. And again, we had a lot of corn that we thought we were going to have to figure out what to do with. So in June, the USDA kept that figure pretty stable. In July and August, we started to see a little bit of a reduction in the projected yield for this past summer. Certainly a lot of your area where we had the derecho taking some yield potential out of the marketplace. So we had a little reduction, but still had the USDA projecting 2.6, 2.7 billion bushels of ending stocks figures. And then we got into the fall, saw a little more reduction in supply, saw a little more interest by China in buying some corn, saw ethanol production start to come back up anyway. It wasn't up to the kind of levels that we had pre-COVID in terms of weekly ethanol production, but it was coming back up, certainly up off the lows of what we saw in March. And then we got into November and December, started to reduce the production IDs even a little bit further, had the USDA projecting about 1.6 billion bushels. And then finally here in January, the government has projected a forward idea of 2021 ending stocks at just above 1.5 billion bushels. Most analysts in the marketplace are quite a ways below that in terms of what they project. And between the recording of this and our panel discussion, the USDA will have come out with another figure in February. So in January, when USDA reduced the supplies, like we talked about earlier, they actually reduced demand figures as well. Most analysts feel like, all right, if we believe the supply reduction, we can take our supply down on our own balance sheets, but we don't believe that demand reduction. We're still going to have demand up here at a higher level in our own balance sheets. And as a result, our own projections for ending stocks for 2021 are going to be lower than the USDA. And I'll zone in on that with a balance sheet here in a few slides. But point is, we've gone in about an 8-month time frame from thinking we got more corn than we know what to do with. Where are we going to put it all? To how are we going to ration production? How are we going to ration usage by worldwide end users? And how are we going to increase production worldwide to get out of the current tight balance sheet situation that we're in? So quite the turnaround. Same kind of a chart here on soybeans, and there are some similarities in the pattern, although some of this is actually a little different. The USDA actually started a little tighter with their ending stocks projection for soybeans. In the May crop report, the USDA was projecting about 400 million bushels of soybean ending stocks. By August, the USDA had bumped that up to 600 million bushels. Started to look like a pretty good crop here in the US. We weren't seeing the kind of aggressive China buying that we since saw later in the calendar year. But then by September, October, November, we had seen China come in with a huge appetite for soybeans out of the US. We were exporting so much corn and so many soybeans in that October, November, December timeframe that we actually had a bit of a loading capacity issue. And it wasn't just at the export points, New Orleans and the PNW, for example, but even some of the river loading points were essentially tapped out by how quickly they were able to execute. So we really had a short-term supply squeeze going on during what's normally the heart of our big supply season. Normally right after harvest, we've got more supplies than we know what to do with. The challenge is to get through October, November, December and get to the springtime. This year, we had a marketplace that really wanted those bushels aggressively in that time frame. So we saw the USDA's projection for ending stocks continue to decline during that window to the January report here, where they're down at about 150 million bushels. That's very, very tight from a soybean standpoint, and private analysts tend to be lower yet in terms of their ideas on soybean ending stocks. Again, just like corn, we'll have had a USDA report by the time we have our panel discussion here. So these numbers will be a little dated by then. Let's talk about globally a couple of quick things. This is a global coarse grain stocks to use ratio, and coarse grains are made up of corn and really any other grain that can be fed to an animal. So barley, sorghum, those would be the big two in addition to corn, but really anything that can be fed to an animal is considered a coarse grain. And we've got three different lines here in terms of stocks to use ratios. And the way we break these apart is in the blue, we've got the total world stocks to use ratio. And a couple of things. You see about a 5-year decline going on there. So the world is on a downward trend in terms of ending stocks. But big picture wise, it's relatively comfortable. You look back over the pre-2012 timeframe, and we're still towards the high end of that globally in total. The red line is the US itself, and we're on more of a 3-year decline. And versus history, we're actually towards the tighter end now. We're projecting about, the USDA, is projecting about an 11% stocks to use ratio. And you look back over the last 30 years, and there aren't a lot of numbers there below 11. So we're getting tighter from that perspective. And the green line finally is the world without China. And China's always been a little bit of an enigma in their corn stocks. Part of that is the USDA several times in my career, and I've been in the business about 25 years, the USDA several times has gone back and made a historic stocks revision for China. And it's easy to throw stones and say, why would you do that, Mr. USDA? But kind of like I was talking about in terms of reconciling data to stocks reports, eventually the USDA felt like it had a pretty good idea on what Chinese corn production was. It felt like it had a little bit of a lesser idea on what Chinese usage was, but it still had a decent idea. And so you've got production, you've got usage, you've got net global trade. Those will end up giving the figure for new crop carrying stocks on any given year. And eventually those supply and demand figures were going to end up with a negative stocks situation for China. Obviously, you can't truly have negative stocks. And so the USDA had to say, all right, something is wrong in our numbers. And what they did is they went back 5 years previous at the time and said, we must have underestimated what their stocks were on that date. And so the USDA increased its previous estimate of Chinese stocks to make the supply and demand figures work. So point of that is when we pull data out in terms of global stocks to use ratios, a lot of times we'll pull China out from a stocks perspective. The flip side to whether their grain stocks are hard to rely on is even if their grain stocks are large, they don't tend to be an exporter of those in high priced years. So if the world has to try and originate new supplies somewhere, even if you take Chinese stocks at face value, those stocks likely aren't available to the world to trade. So point of that is we strip out China on those numbers. So the result of that, the result of tighter world stocks is the US has increased its share the last year or two of total world trade. The blue line here is the percent of world corn trade represented by the US. And going back to the year 2000, we were about 65% of the world corn trade. US exports represented 65% of total trade. That number was relatively steady for about a 6 to an 8 year period. And then we had our tight supply scenarios in 2008, 2012. We went down to a low figure in terms of total corn trade. And this year we've had to come back up. the U.S. is becoming a little bit of what we call a residual supplier. And the best way to illustrate that is to talk about how the U.S. operates in the world wheat trade. We're very much a residual supplier in wheat. You know, year in and year out, we are not the cheapest origin of exported wheat worldwide. It tends to be the European Union, the Black Sea, actually, in particular, Southern Hemisphere countries of Australia and Argentina. And the U.S. tends to be the residual, meaning when those places have crop problems and they run out of supplies, the world tends to come knocking on our door. And we've got, still the most efficient transportation assets, the most efficient storage assets. And it's important to note that we're paid for having those. Where we think we'd like to be the number one world supplier of everything, we do get paid for being able to keep stocks around like we do and to be there as a residual supplier to the world. So on corn, we're not nearly as residual as we have become on wheat, but we are gravitating towards a little more of a residual supplier as we continue to see increases in production in the Southern Hemisphere and competing countries. So in the near term, the good news from a farm pricing perspective is when the world does need to come knocking at our door, we tend to be well paid for it. And we're certainly being well paid today with corn futures above that $5 level. So let's talk about whether those exports can continue. This week, we've seen a lot of daily export flashes to China, and the USDA requires daily reporting of large sales by exporters. And we've seen 2 flashes this week of over 1 million tons, which is over 40 million bushels of corn sold directly to China. We obviously have a trade agreement with China still in place today. And so China has some political reasons to want to buy U.S. production, but they also have legitimate economic reasons to want to buy from the U.S. The biggest driver of that is their hog margins. This is it's rough numbers, but it's a feeding margin estimate for Chinese hogs. So buying corn, selling hogs, this is the kind of margin that's left over. And it's their rebuilding of their hog herd after the decline that they had due to African swine fever that has led to their big appetite for corn. And a big part of that is coming from the U.S. today. As long as these margins stay high enough, they look likely to continue to buy. So point of that is they're not doing it just from a government trade agreement perspective. They're doing it because they've got good economic reason to do it. Here's another way of looking at China. This is a chart of imported corn absent a tariff. So that's the blue line, the price of U.S. imported corn. And the orange line is Chinese corn, an internal price in one of their key feeding areas. So as long as the orange line is above the blue, there's at least a theoretical margin to import corn. Now, if we go applying tariffs and things like that, this margin disappears. And that's why they haven't bought more corn today than what they have. And it's why they have aggressively bought U.S. sorghum and other non-tariff type commodities. But when they do allow corn in without an import tariff, there's a good margin there to do so. So combine the high hog margins with a good import margin on corn, and that's why we see them doing the buying that they've been doing this week. And the uncertainty of how aggressive that will continue is what's giving analysts the biggest challenge in terms of deciding how aggressively they want to pencil in further Chinese corn imports for this marketing year. So let's look ahead to next year. We've talked about high corn prices. We've talked about high soybean prices. We've also got high wheat prices in the U.S., and we've got high oilseed prices for things like canola. So we've got an acreage battle in the U.S. coming from all commodities. It's not just like a year when we need to shift a bunch of soybean acres to corn or vice versa. We've got every major commodity essentially competing for acres. From a micro perspective, corn versus soybeans, this is the bean to corn ratio. And for this time of year, we do see that relatively high, which suggests all things equal is shifting to soybeans away from corn. Challenge is obviously corn doesn't want to give up those acres. So when soybeans get a supply and demand driven rally, we end up seeing corn having to keep pace. And a little bit of the opposite is true as well. So the bigger question in the U.S. is what can we do with total acres? This is a chart of principal crop acres in the U.S., and the orange line is planted acreage. And the biggest thing we see on this chart is our last time of really high prices, 2012, 2013, 2014. We saw some fairly high planted acres relative to what we've seen the last couple of years. The question is, do economics work enough to get us back to those kind of levels? or have enough things happen in terms of urban sprawl, permanent CRP type acreage, have enough things happen there to make that more of a challenge and not able to occur. And we don't, nobody's got the direct answer to that, but we have in recent history grown quite a few more acres than we have in terms of total crops the last 2 years. So the market really needs that sort of additional acreage to occur. So if you've got a 40 somewhere that you haven't planted the last couple of years, the market is saying, get out there, bust that sod and find a way to put that back into production. We're coming up on the crop insurance pricing time frame in the spring, and it's no secret we're at very high prices. So looking at just a 5-year price chart, assuming we don't crash in prices here in the next 3 days, we're going to head into February and start establishing the corn and the soybean spring planting price average, and it looks like it's going to be at some pretty high levels. So it's giving an opportunity, as long as we don't crash, it's giving an opportunity to lock in some pretty good revenue potential. And we think that's very important to do in this scenario. So we're getting close to the end here. I know there are a lot of numbers up at the balance sheet, and I always hear everyone's eyes rolling to the back of their head. What I want to do is pull out just a couple of quick highlights here to talk about what's important looking forward on the corn and the soybean markets. So first of all, the USDA in January, like we said early on, forecast an ending stocks figure at 1.5 billion bushels. Most analysts, including our own analysts in-house, are using a figure a fair bit lower than that. We're at 1.2 billion bushels. That gets below that magic 10% stocks to use ratio, which is where the market says, wait a minute, we're a little worried about running out here. And we have a second column where we bump our exports a little higher with action that we've seen from China here the last couple of days. And when we use that more aggressive export figure, we get down to just above 1 billion bushels on our stocks to use ratio on corn. That starts to get pretty tight. Stocks to use ratio wise, it's really tight. From a raw number standpoint, 1 billion bushels has always kind of been a comfort level of the marketplace. So seeing that figure get down towards 1 billion, that's pretty tight. Looking ahead to next year, we've bumped our acreage up in our balance sheet by 3 million acres planted compared to this past season. We've got a trend line yield, which obviously we've got a growing season to go yet to get there. But even with that trend line yield, we still just end up with a new crop. This would be August 31, 2022, a new crop ending stocks figure of 1.4 billion bushels. That's not a figure, that suggests $8 or $10 corn by any means, but it's a figure that is going to have the market very attuned to planting issues in the spring, dry season or other growing season issues in the summertime. It's a market that's just not going to be very comfortable as long as our forward projections end up at that kind of a level. To go through the same kind of math on soybeans, USDA came in January at 140 million bushels in terms of U.S. ending stocks. That's below a 5% stocks to use ratio. So that's pretty tight on its own. And most analysts, including our own, are tighter yet, 112 million bushels. Again, the USDA will have new balance sheet figures in February prior to our panel discussion, but these are the figures from January and the current figures from our analysts in-house. Looking ahead on soybeans to the tighter ending stocks figures, whether we use a little more aggressive export figure or not, we still have ending stocks figures on our own balance sheets under the 3% level. That's tight. That's a market that says we need to see some kind of export cancellation, or later in the marketing year, we need to be importing some soybeans. And I know as producers, we never want to hear, hey, we're importing soybeans, but balance sheet wise, that the market is saying we need to keep exporting in the near term. We may need to be doing a little importing later in the summertime. We'll see what happens in that regard. So then looking ahead to the new crop time frame, we bump acres up a fair bit from this current year, but we still don't really rebuild supply very aggressively. Still just a 200 million bushel carry out. And if that ends up being a high water mark, like early projections often are on soybean carryouts, it suggests a lot of volatility continuing on the soybean side of things as well. So finally, to conclude, just a few wild cards I want to bring out here. I know that data and info ends up sounding like kind of a bullish scenario, and it's probably good reason to suggest it is kind of a bullish scenario here, but markets are markets and futures markets are future markets. And so to that end, they incorporate really all the info that's available to everyone at any given time. So the question we start to ask is, what could change? What could shift this scenario dramatically? And one of them, the biggest one, Brazil grows two corn crops. They grow an early corn crop that is about a third of their total production, and they grow a second corn crop that is the larger of the two. And it's the one that ends up supplying the export market later in their marketing year. And that crop is just going in the ground. So there's a lot of story yet to be told on that. Ethanol policy is a real question with the new administration coming into place. One fear was that the outgoing administration would grant a bunch of small refiner exemptions, allowing some blenders out of the renewable fuel standard. And that happened to a much lesser extent than had been feared. So ag-wise, ethanol-wise, that was good news. However, we've still got a new administration, and that policy remains to be seen. Electric vehicles are a threat longer term to the ethanol industry. General Motors today announced that by 2035, they plan to sell only electric vehicles. The world is dynamic. That may or may not happen, but that's what was laid out today. We talked about the acreage battle. We've got a lot of that's going to go on this spring, and we've got that worldwide as well. Will we see acreage changes in the Black Sea or further changes in South America? And then finally, the question is China for real, or are they just buying based on the trade agreement, or are they in a bubble and they're going to go away suddenly? So as I have up there, all we know for sure is we're in for a wild ride. So thank you. I look forward to the questions in the panel, and we'll answer those then. Thank you.
Thanks again for joining us this morning. As a reminder, there will be a QR code shown at the end where you will be able to scan with your phone to register for CCA training credits. As another reminder, you can enter questions in the YouTube chat at any point in time. I will be watching them come in and asking the panel the questions. You can also email them to questions@liqui-grow.com. Okay, so to get started, we're going to have our panel introduce themselves, starting with Jake.
Yeah, so I am Jacob Vossenkemper. I work for Twin State Incorporated. I am the agronomy lead here at Twin State.
Thank you, Jake.
Good morning. I'm Kurt Struber with Advanced Trading in Bloomington, Illinois. I'm the chairman of Advanced Trading and a risk management consultant.
Hello, I'm John Tinsman. I work for Twin State Inc. I'm the director of purchasing and trading.
And I am Scott Tinsman, Chief Operating Officer of Twin State and Chairman of Rock River Lumber and Grain.
Okay, thanks guys. So we did have some questions come through during the presentation. First one for you, Kurt, is what is your assessment of current grain buying habits in China?
Thank you. That's a great and very timely question. I'm sure most of you are aware China has bought record levels of U.S. corn this year. They came into the current marketing year, which started on September 1, with a record level of corn already pre-booked that had been bought ahead for the current marketing year. And they bought fairly steadily through the fall time frame, and then bought very aggressively in late January. So the question of how much corn China is going to need to import in total is still one being debated by the analyst community. And the low end of estimates there would still be a record level. So the question is, do they jump to a new record, or do they go even higher than the current projections, or are the current projections where they top out? And just to emphasize, those current projections would be record type levels. So the question is China importing that much corn because they have legitimate corn usage demand, that they're going to grind through that corn and use it, or are they stockpiling for some kind of a geopolitical reason? And we tend towards believing that the former part of that they have legitimate usage demand for the corn. China's been rebuilding their hog herd fairly aggressively after the African swine fever kind of decimated their hog numbers 2 years ago. And it looks like their feeding margins to hogs are very positive. So that's a lot of reason to bring in the corn and feed it. And it looks like they have a pretty healthy import margin today as well. So it would look like the economics are working as opposed to stockpiling. But China's always been kind of an enigma in the marketplace, and they could turn around and surprise us on a moment's notice.
Mm-hmm. Okay, great. Thank you very much. There is a follow-up question to that.
Sure.
What changes in the U.S.-China relationship do you predict in 2021?
That's a great question as well, and predicting political changes is always difficult. You know, the Trump administration had taken a very hardline stance with China, at least publicly, from putting tariffs in place to saying we're not going to trade if human rights conditions don't improve, if China's currency manipulation doesn't change, and the Trump administration was really holding the line, at least publicly, in that regard. The Biden administration appears to maybe be taking a bit of a softer stance there. Some talk of removing some of the trade tariffs. So from an agricultural perspective, in the short term, that might be a good thing. It may lead to China buying more U.S. goods, although we saw them start to buy U.S. soybeans really aggressively about 6 months ago anyway, even with the Trump administration still in place. And obviously, like in the previous question, we've seen them buying corn fairly aggressively. So I'm not sure the administration change would lead to a big difference from an ag perspective. It's probably a bigger question about just the future of China trade in general and where China fits in the world. Lately there have been some overtures about China and Taiwan, and we obviously hope that doesn't escalate into military type action, but it is kind of a tense situation still, and that'll be a big part of the foreign policy needs of the new administration.
Great, thank you very much. Jake, you said that you had a question you wanted to ask Kurt when we got started today.
Yeah, absolutely. So if I'm a farmer, I'm feeling pretty good about current, the current corn and soybean prices relative to some prices we've had in the last 4 or 5 years. Other than China, which we talked about that earlier, but other than China, what are some other factors that could, dictate or change the trajectory of corn and soybean prices? John said the stock market's taken a hit the last couple of days because of inflation. What would inflation do to corn and soybean prices?
Sure, and I'll be glad to let John ring in as well on this. Inflation from a big picture perspective in ag is positive from an output pricing standpoint, negative from an input pricing standpoint. So a little bit of a trade-off in that regard. To your question of world trade and non-China type questions, the U.S. has been trending a bit towards becoming a residual supplier, and we talked about that a little bit in the recorded presentation. And by residual supplier, what we mean is we're not normally, in times of grain surpluses, we, the U.S., are not normally the ones who've got the cheapest grain available to be the first storefront that someone's going to come through. Instead, we get paid for storing grain, for keeping grain in good condition, for having the world's best transportation system. And ultimately, when the world does need to come to the U.S., we get rewarded pretty handsomely like we are today. China is so big that they really dominate the question of world trade. But absent China, our trade to Western Hemisphere countries has actually been a positive from an ag export perspective over the last 10 years. We've seen growth in that arena, and what's nice from a farm perspective there is we have a transportation advantage to countries like Mexico, Central American countries, the northern countries in South America. So I got off your inflation comment just a little bit. John had some interesting comments earlier. I might defer to him.
Yeah, so first of all, inflation is just when things cost more in dollars. It doesn't necessarily mean they actually cost more. It just means that you get less for your dollar. So let's say that you can buy 5 gallons of milk with $5, or you could buy 1 bushel of corn. Now, in inflation, and say we had 100% inflation, a bushel of corn would cost $10, but so would 5 gallons of milk. So a farmer would still be able to get the same amount of product per bushel. So it shouldn't matter too much from a business perspective. Where it really starts to hurt is people that have a lot of cash or a lot of bonds, or people that have been not locking in their prices as they go, and all of a sudden they have to pay very high prices for things, and they might not have the cash to do it due to their cash losing so much value. But that being said, I don't think we're going to experience inflation that high. The fear is that over the last month, the U.S. recorded 1.3% month over month inflation, which could hint to a 15% rise year over year, which would be the highest inflation the U.S. has seen in decades. And many of us probably don't remember well the 70s or 80s when there was very high inflation.
I do.
John, we don't do it.
But I personally don't think we're going to head down that route. But the reason that's been driving that inflation is something that you guys have all been seeing every day in your everyday lives. You've seen some commodity prices like milk or eggs go up. You've seen your gasoline prices go up month over month. You've seen your corn prices go up month over month, soybeans. And so those even metals, everything is really, especially in the commodities, taking a turn up. And so all of that drives higher prices to the end consumer. And that's what the end consumer is experiencing right now. And I do think we could see, strong inflation this year, but I think it would probably taper off, in my opinion, after that.
So John, inflation then could continue to drive up corn and soybean prices, but inputs would also go up quite a bit, so it's going to offset one another.
Yes,
Is that-
yes.
Okay.
Fortunately, Jake, as you look at the 21 crop year, I think a lot of farmers were able to have a great fall. And so they got their inputs or their fertility inputs down before the higher prices kicked in. Most of these higher prices for fertilizers didn't kick in until January. So I would say the farmer is in pretty good shape for this year. Now, a lot of people have asked the question, what do we think about the input prices or the fertilizer prices for next fall? And my 30 years of experience will say, we won't know those until we see the price of corn. If the price of corn stays high, I think these input prices are going to stay high. If the price of corn falls back to $4 or $3.90, I think you'll see the input prices have to go backwards. Otherwise, they're not affordable. So I think when somebody says, well, would you buy fall input prices today? I guess I'd almost look to Kurt to say, Kurt, is the price of corn at harvest time going to be above $4.50?
Right, and with my farmer hat on from a farm background, I would say I sure hope so. I hope it is. We're still going to be fairly tight from a balance sheet perspective into next year, and it doesn't mean prices have to go higher or stay high even, but it does say we really need good yields here in the U.S. if we're going to turn around the tight stock situation that we're in today.
Okay, so you make a very interesting point. Good yields in the U.S. if we're going to at least even stay comfortable with the stocks. What is that on a bushels per acre average? I mean, are we talking about 175, 179?
Nationwide, we'd be approaching that 180 level, and that assumes we can plant the 92 million acres. The acreage question is an interesting one this year because often we've got a mix of a simple question of, do soybeans need to grow acres at the expense of corn or vice versa, where this year the marketplace needs a lot of corn acres, a lot of soybean acres, and we've got high wheat prices, and we've got high oil seed, i.e. canola prices in the West, which makes it hard to get the wheat acreage that we need. So we've really got a competing mix of all the commodities for a finite number of acres, and that proves a challenge.
Okay, so obviously the weather patterns lately have been wild. What if we have a very dry July? What do you think happens to the price of corn, given that we're already at $4.50 for new cropper?
Right, absolutely. Things will get very interesting, which might be the understatement of the year. If we start to threaten the national average corn yield by 5, 7, 10 bushels per acre, or the national soybean yield by 2, 4, 6 bushels per acre. And that assumes that Brazil can grow a normal second corn crop, which is going in the ground later than normal as we speak. And we saw here in the U.S. 2 years ago, I believe, late planting doesn't have to mean bad yields. We grew a pretty good corn crop that was planted in late May and early June, but the averages aren't on the side of putting a crop in later. So, they're off to a questionable start in Brazil, and it sets up the question about U.S. summertime weather for sure.
So, follow-up question that's coming through the email for John, and we've kind of addressed this a little bit, but 2022 crop input prices, opportunities, and timing. I guess anything to elaborate on for that?
Well, right now we're actually in a great deal of uncertainty. This cold Arctic polar vortex that came down turned off a lot of input for nitrogen. Certainly, they just had their natural gas shut off to the plants, and so we lost up to 2 weeks of supply there. We've had a lot of the refineries which supply sulfur shut off for 2 weeks, and so ammonia supplies are very, very tight. We've got tight urea supplies, and we have imports of those products actually down year over year, including in UAN. So right now, it's hard for me to talk about a whole year out, but right now I think that there's a lot of uncertainty even over the next couple months, and it'll be interesting to see once these plants get fully back up and operational, what they set the prices at.
Okay, good, thank you. Kurt, another question that came in for you.
Sure.
What risks and opportunities are available to growers with the new administration?
So anytime there's a political change in Washington, their ag policy is a fairly government intensive kind of a thing, and so anytime there's a new administration, questions come up about what's that going to mean for farm policy, and more specifically, I think today especially, what does that mean for ethanol policy? So going back to the previous administration briefly, there'd been some fear in the ag community that on the way out the door, that the Trump EPA would grant a large number of what are called small refiner exemptions to the ethanol industry, which would allow some refiners to not have to blend the same amount of ethanol under the renewable fuel standard as they previously had to. And that fear was not realized, not in a major way anyway. The outgoing EPA granted, I believe it was just 3 small refiner exemptions, and so in total, it wasn't a lot of loss to mandated ethanol demand. So the question of the new administration is, are they still as supportive of ethanol? Do they continue to respect or enforce the renewable fuel standard as it is today, which mandates a fairly aggressive level of ethanol blending here in the U.S.? I haven't seen any indication that they aren't doing that. The new ag secretary is an Iowan, is a good ag guy. The new EPA administrator is thought to be relatively friendly to ethanol. So signs are somewhat positive towards the ethanol industry, and we'll just see going forward. Electric vehicles are our big pressure against ethanol policy, and that's something that is likely coming regardless of the administration. So that may be a threat longer term to ethanol, but not necessarily specific to the new administration.
Okay, great. Thank you very much. This is kind of a follow-up question to that. Are there regional or local economic or political factors that might impact farmers in the Midwest specifically?
Sure. So big picture wise, one of the things that really varies between agriculture, production agriculture and demand, and something like, say, the coal business or the energy business is we vary our geography of grain production. Some of that's weather-wise, some of it's acreage mix, but we vary that year in and year out, and we vary demand points year in and year out. If it's an aggressive export year, then export-oriented rail houses can transport a lot more grain in that kind of a year, or river shipping houses can ship a lot more grain in that type of a year. Or if it's a non-export intensive type situation, then demand points end up being more domestic processing, domestic feeding, etc. So we end up with a lot of regional differences, even without any political changes. The 2 biggest things affecting regionality of ag to me would be that ethanol policy again. Take a worst case scenario and say ethanol demand was cut by 1/3. That would affect a lot of ethanol plants, and a lot of them would be right here in Iowa, because it's an ethanol intensive state. Export wise, if our policy were to change, or if something changes with regards to China and our exports kind of regress to the mean, then that makes the river a little less relevant than it has been today from an export shipping perspective. So all things equal, it affects those regional economies that are more dependent on ethanol and export demand. But in the short term, I don't see real immediate changes related to the administration.
Okay, great, thank you. Another question that came in through the email, and this will be open for the panel, maybe we'll start with the Tinsmans. What are your thoughts on the price run-up in January? Seems atypical for this time of year.
The price run up on fertilizers or the price run up on grain?
I guess either.
Well, as I sort of said earlier, the price run up on fertilizer is, in my opinion, strictly following grain. The manufacturers, which you can count them on one hand in the United States, recognize that the farmer has more money, that he might put a little bit more fertilizer on because the grain prices are higher, and so they feel like they can raise the price. Again, the manufacturers in the United States can all fit in one golf foursome. So it's no different than watching American Airlines and United and Delta. One raises the price, they all raise the price. So, you know, I'm a little jaded when it comes to that. They're gonna capture what they can capture. In terms of the grain prices, you know, it's my opinion, you know, I'm not used to seeing large run-ups in the grain price in January, so I figure that's, to Kurt's point, been more of a demand issue versus a weather issue.
So I have a follow-up question to that. So let's say that I'm a young farmer, I'm 36 years old, and I'm taking over Dad's operation. Got a lot on my plate at this point. Since I've been involved in production ag, fertilizer, commodity prices have always generally followed one another. Is that always the way it's been, Scott? And do we expect that to continue as time goes on?
The fertilizer prices tend to follow.
Yeah, has that always been the case? Have fertilizer always followed
You
grain
know,
prices?
it may not be a perfect correlation, but I'd say with 90% accuracy, I mean, if you go back when we hit corn at $7, you know, we had phosphates trading up at $1,000. So I would say yes. I mean, they sure seem to be closely correlated, and no, they may get out of sync by a few months, but I think just like everything else, the world's spinning faster. Now I see those, they're not gonna get out of sync by 6 months. They'll get out of sync by maybe 2 weeks, but they're not getting out of sync.
So you see that trend continuing? So
I do.
if I'm a young farmer, I can expect fertilizer prices to follow corn prices.
It
for
sure
the time
feels
being.
like that to me. I mean,
Yeah.
any other thoughts?
No, and I guess I'll go back to that 2022 question. You know, right now we see that backwardation in corn where December's trading at 450 a bushel, and March is around 550, and we see that in the futures market, like in UAN barges in NOLA, you're seeing that same backwardation where the prices are right now in December trading at lower in fertilizer inputs than they are today.
Okay, thanks. Sorry, I think we had a battery change there, real quick. So we're right at the 10 o'clock hour. As we're wrapping up, I guess, Kurt and anyone else, you know, we're wrapping up first quarter of the year. Growers are getting ready to start planting. What are two things they should be keeping their eye on as they start to get busy and the day-to-day operation becomes the focus? What are two things they should keep their eye on?
Sure. From my perspective, price management is always the biggest key. And a couple of quick comments on that. We're 3/4 of the way, maybe more so, through the crop insurance pricing window in February here, for which fall harvested commodities pricing levels within revenue insurance are being determined. And they're going to be at 8 and 10-year highs, it looks like, on corn and soybeans. So from a crop insurance perspective, there's an opportunity to protect a lot of revenue, and we strongly encourage doing that. And then we like to take that a step further. Crop insurance, of course, has a pricing determination window of February for the spring price, and then October, November for the fall pricing period. But the generic crop insurance policies don't do a lot of price protecting for the time frame in between. And I know there's some add-ons and things that can be done. And the point is, don't ignore that time in between. If we get into either a wet spring or, like Scott asked earlier, a dry July kind of a time frame, we could really see some unprecedented pricing action that's occurring. And we're big believers at Advanced Trading in using the options market to protect revenue, but still allow a producer to participate, if prices are to go higher yet. So I would certainly encourage looking at an options-based strategy if you're able to set floors higher than what your crop insurance has already determined here in February.
Great. Anybody else? Anything to add?
No, that's a good one. I mean, I think to Kurt's point, just planning ahead. You just can't go to sleep in today's world.
Right.
And, you're going to be looking at the summer months and saying, okay, my crop's in the ground, but that doesn't mean to ignore what's happening.
Yeah, I'm gonna make an agronomic point. I think we can plant our crop in an extremely fast pace these days. We have a lot of the fall field work got done. A lot of fall anhydrous got put on. The crop's gonna be ready to be planted when the weather gets good and things dry out, and we can plant the crop really fast these days. We got fast planters now, big planters, but take your time. Wait for the right weather. Spread your risk out a little bit. Don't slam it all in 4 or 5 days just because you can. You know, we don't, at this latitude, we don't lose a lot of corn yield until after the 15th of May. So if we have a warm spring, which they're predicting, and things dry out, take your time a little bit. Don't slam it in 5 days just because you can. That'd be my advice to farmers. Spread your risk a little bit.
Great, thank you. This was excellent. Okay, and thank you to all of you who joined us today. We had a large viewing audience. If for some reason you think of a question after the fact that you didn't get a chance to ask this morning, our email link is still live, questions@liqui-grow.com. And don't forget, on Thursday, we have our last Lead Academy session. It's going to be an excellent panel discussion specifically focused on the ag markets, ag economies, anything you want to ask about ag. We will have several experts on our panel. It will be a full session of Q&A. So you can start submitting questions now if you want. And we will have live Q&A for the entire hour. We hope to see you then. Thanks for tuning in and have a great day.